Hello again, everybody. Welcome back to our write-offs for real estate investors, hosted by Bernard Rees and Michael Plux. So today is our episode number 11, and I so waited for this particular episode because my Russian accent is perfect for announcing it. I was just waiting for that moment so I can say the topic for today is financing, refinancing, and BRRR strategy. Okay, so we are talking today about financing, refinancing, and BRRR. And Bernard, okay, before we talk about that is okay, our slides are going to show our standard procedure for our episode where we talk about benefits, we talk about gotchas, and we talk about execution. Okay, when you have a chance, bring up our slide, please. Okay, and financing is the first part. So financing is the very confusing part when an investor buys a property, because the question always comes up: if I bought the property for cash, it's very clear. Okay, I paid 100,000 for the property and I set it up for depreciation. Now, when you finance that and you brought 20,000 cash to closing, do you deduct down payment, or what do you deduct, Bernard?
Yeah, let's do it. And I love that we're starting with financing because there's so much discussion on the refi component, but financing is really important. So financing gives you incredible tax benefits in many ways. Just as we understand that you get leverage, you use financing to buy more real estate, you also, in a sense, use financing to get more tax deductions. Now, the obvious tax deduction is going to be the interest expense. But more importantly, the entire purchase price is treated as your purchase price for tax purposes, even if you got the money from the bank. So your depreciation tax deductions, your basis in the property for all tax purposes includes the portion that you acquired through financing. And I think what's really helpful is to understand that in the eyes of the IRS, there are really two separate transactions going on when you buy a property with financing. There's a real estate transaction, and your contract with your seller will say the purchase price of the property, the sales price of the property is $500,000. Well, that $500,000 is going to be your basis, of course, plus or minus other stuff. But basically, that's the starting point. There's a second transaction, which is how do you actually get that $500,000? Well, you got a portion of it from the bank. That's financing. That's, in the eyes of the IRS, that is an independent transaction. So even if your cash down was only 20% of $500,000, or even if you use some sort of creative financing and your cash down is zero cash down, as it says on TikTok, everybody can buy properties with no cash down. Your tax basis is still going to be what it says in the real estate contract, which is that $500,000 purchase price, and all the tax implications will flow from that $500,000 purchase price, even with no money out of pocket.
Excellent explanation, Bernard. Okay, I want to rephrase it slightly, but first I noticed something interesting in our episodes, our geographical differences. See, I'm based in Houston, Texas. My examples are 100,000. Yes. You're based on the East Coast. Your examples are 500,000. Well, clearly says where we are from.
Well, okay. I was actually aiming for like a good compromise, because on the East Coast, $500,000 here doesn't get too far either.
Okay.
I was looking for the midpoint.
Okay. So to finish our talk about financing, what Bernard was explaining is this: whether you purchase the entire 500 property in cash, whether you purchased it with 400 financed and 100 in cash, or 500 financed and 0 in cash, your depreciation and your tax treatment of that purchase is exactly the same, except you also deduct interest on financing, and there are special treatments for closing costs related to that, which we are not going to go into. So that's as far as financing. And then comes refinancing. Okay, so refinancing has the biggest benefit. One of the biggest benefits of real estate investments comes from refinancing. So what is that benefit, Bernard?
Yes, so this is amazing. Well, first, let's talk basics. What is a refi? Where does a refi come from? What do we mean when we say cash out refi? Well, when you purchase a property, all cash or with financing, you may have inadequate equity in the property to pull money out. But 2 years later, your property has gone up in value. And now the bank would theoretically say, you know what, a property that's worth, you bought it for 500,000. Today it's worth $1 million. Today it's worth $1 million. Well, you have a choice. You could sell the property for a $500,000 gain, or you can go to the bank and say, you know what, this property is worth another $500,000. Would you give me a $500,000 loan against that additional equity? Because the bank would say, yeah, you know what, the property today is worth more. So based on our loan to value calculations, we can give you another $500,000. So let's model out from a tax perspective the implications of selling versus taking money from the bank. Well, if you sell the property and you realize that gain, you have that $500,000 built-in gain, and then you sell it and you realize it, you're going to have a $500,000 capital gain upon which you have to pay taxes. You'll also be giving up future appreciation of this property. And hey, this is a great property. Why give it up? Well, the alternative is to go to the bank, and rather than selling the property, you get your $500,000 by taking an additional loan, a refinance. The bank will give you $500,000. What are the upside of this? Two wonderful things. On the tax side, a loan creates no tax liability. So you have $500,000 in your pocket, but you did not realize any capital gain. And secondly, you still own the property and get to benefit from future appreciation, from future rents. So a refi essentially gives you access to incredible financial benefits without having to pay any taxes today. So
is
great
that
benefits.
What people talk about when they use that wonderful BRRR?
So the BRRR method has that, but it has additional components because BRRR actually means that you're moving into the property using a, let's back up. That's something, but you could use it with that. But yes, BRRR is buy, rehab, refinance. Am I missing? Which R's am I missing?
Repeat.
Repeat. Okay. How many R's? I think we had that's 3 R's.
Yeah, people keep adding a lot of R's there, but I have limits of how many R's I can stretch when I say that. But the point about that abbreviation is exactly what Bernard was explaining, is that what you are doing is, instead of selling properties, you pull out equity in cash, and you do not pay capital gain taxes or any kind of taxes on that cash, which sounds absolutely fantastic. Like, everybody would, like, what can we love more than getting money and not having to pay taxes on that? And if it was completely true, if it was the full story, it would have been even better. But unfortunately, it's only half of the story. Another half is on our slide in our gotcha. Here is what happens. Sometimes people get a little confused on how capital gain tax is calculated. And we have next episode where we are talking specifically about capital gain taxes. So I'm a little bit like getting ahead of ourselves here. However, what is important to remember is this. People confuse cash that they receive at sale with the profit or capital gain. So the way they sometimes calculate, and this is wrong, would be this. So we're buying that property for 500. The property appreciated up to $1 million. Of course, the bank is not going to give you another 500. They would give you maybe another 300. Okay, so we had refinanced our original 500 into 800, right? So what sounds is when we sell the property for $1 million, eventually we pay off the 800 and the difference is 200. 200 is what you roughly will get in cash if you sell property after refinance. And people say, okay, I'm going to pay taxes on 200. No, sorry. You're going to pay taxes on the original purchase price of 500, and difference between that and the million, that's 500 gain, not 200. And if you do math, this is the 200 that you already calculated, plus 300 cash out refi, which was not taxable when you redid the refinance, but eventually catches up with you when you sell the property. And that's our gotchas. And we close by always going into execution. So what do you recommend for the execution steps for our listeners to remember, Bernard?
So the execution always follows from the benefits and the gotchas. The reality is that a cash out refi is an incredible benefit.
It is.
And in most scenarios, investors should move forward with that cash out refi. In real estate and in all tax games, it's always about getting money today to buy more properties and kicking the tax can down the road. And thankfully, when you kick that can down the road, you're able to plan for it. And real estate provides for great planning tools covered in different episodes.
Which will be episode 2 episodes from now, episode number 13. We will talk about that wonderful tool, which many of you know, 1031 exchanges. But until then, everybody have a great day. If you have a lot of equity, go kind of explore refinancing your properties, pulling cash out of that, and we will see you on the next episode.
Thank you all. Thank you, Michael.